P2P lending promised to change how Indians invest and borrow, with higher returns for lenders and easier access to loans for borrowers. But just as it was gaining traction, RBI dropped a set of strict guidelines in 2024 that shook up the industry. So was that the end of P2P lending in India, or just a beginning of a new chapter? And what does this mean for you as an investor? Let's unpack everything in today's video. First, a quick refresher. Peer-to-peer or P2P lending is a way for people to lend money directly to borrowers through online platforms. For lenders, the pitch is simple: higher returns than fixed deposits and some mutual funds. For borrowers, the appeal is easy access to credit, especially for those underserved by banks. Sounds like a win-win, right? Well, not quite, because in 2024, the RBI stepped in with stricter rules. But what were these rules, and how did they impact the industry? Let's break down the major ones. First, the RBI made it crystal clear that the risk sits fully with the lender. If you're lending on a P2P platform, you have to accept upfront that your money could even go to zero. Platforms now have to give this disclaimer, which means no more marketing P2P as a safe product with fixed returns. Second, the regulator cracked down on cross-selling. Earlier, some platforms would nudge you towards other financial products while you were investing. RBI shut all of those down except for loan-related insurance products. Then came the toughest one: escrow accounts and the T+1 rule. So every rupee that you invest has to move through a third-party escrow account. But here's the catch: if a borrower's loan isn't fully funded within one day, your money gets refunded. Earlier, listings could stay open for weeks. Now, that flexibility is gone. For investors, it can feel messy. You put in 1 lakh, but only part of it gets matched. And the rest comes back to you to reinvest, spoiling your overall experience. Another big change was around fees. Platforms can no longer tie their earnings to whether borrowers repay. They can only charge a flat fee or a percentage of the loan amount. Predictable, yes, but it limits how creative their revenue models can be. And finally, no more closed group lending. Remember those fancy offerings like CredMint or BharatPe's 12% club? They had tied up with a P2P player at the back end and relied on matching lenders and borrowers within a closed community. The RBI banned that practice and these programs had to shut shop. So what happened after the guidelines? At first, volumes dropped. Big names like Liqui Loans paused new loans. Some players downsized, and the payment apps that had partnered with P2P platforms, they shut their lending programs. But not everyone disappeared. Players like Lending Club and India P2P rebuilt their systems. They stayed compliant and are already bouncing back. Industry disbursals today are only about 15 to 30% of pre-2024 levels, but they're rising steadily. In fact, India P2P's volumes are already close to where they were before the guidelines. And they're also seeing a reduction in customer acquisition costs. It's logical if you ask me, because fewer players mean lower competition. And that's actually reduced the customer acquisition costs for the platforms that survive. And here's something interesting. New fintechs like Jupiter and One Finance are also reportedly exploring P2P licenses. So the story isn't that P2P is dead. It's more like the dust is settling. But what does this mean if you're a new investor? Well, the bad news: P2P is no longer pitched as a risk-free alternative. You need to go in knowing that defaults are possible and your capital is at risk, even possibly going down to zero. 2, the overall user experience may not be as great as earlier. I mean, you wouldn't want to keep getting refunds that you need to invest again just because of the T+1 settlement rule, right? 3, the flexibility to invest anytime and withdraw anytime has gone, thanks to, again, the mandatory T+1 rule. The good news though, the platforms that remain are more compliant and transparent than ever. RBI's regulations may have slowed growth, but they've also consolidated the industry and set some good guardrails. And that sets the stage for healthier, more sustainable growth in the long run. The most important thing is that if you're looking at P2P lending today, think of it as an alternative investment option with risks, not a replacement for fixed deposits. Well, that's it for this video. Thanks for watching. If you've stayed till here, I'm sure you'll love our newsletter where we decode more alternate asset classes like this one. The link is in the description below. Also, don't forget to subscribe so that you don't miss out on our next deep dive.